Hi everyone. We're back for this little bit more on Chapter 7, Payroll. So after battling Pearson, we're going to give it a go one more time, and hopefully they have strengthened their website so that you are not having trouble accessing your homework. Anyway, so we're going to continue on with payroll. So now you learned how to do the deductions, you learned how to calculate their gross earnings, all of their deductions. Hopefully you were able to figure out the OASDI and the Medicare. That's a little tricky. We'll go over that a little bit more. And then calculate individuals' net pay. So that was 7.1. So 7.2, come on, 7.2 is going to be how to prepare a payroll register and maintain an employee's earning record. Okay, so payroll register is basically where we keep everything all together, the employee's payroll. And the reason why payroll is important is A, if you're running a business, that's money coming out of your business. B, another reason is because a lot of times if you start as an accountant working for a company, maybe as an assistant, a lot of times payroll is, the designated area where we're going to go to work. So it's good to know this information. So this is what is contained in the payroll register, all the things you just got done calculating. So it's got each employee's gross earnings, so that's just their hourly or their salary. Their withholding, remember that's federal income tax using a tax table. And then all the other taxes are their deductions, which could be OASDI, Medicare, medical insurance, things like that. Subtract all those from their gross pay and you get their net pay. And then the other thing we have to be aware of is their taxable earnings, because the employer has to match Medicare and OASDI. The taxable earnings, remember, once you make $127,200, you no longer have to pay OASDI. You don't have to take that taken out of your paycheck. And then your cumulative earnings to see how close you are to that 127. The majority of people don't make that much. They don't have to worry about it. And then if you have different parts of your company, like different areas where payroll is charged to. So you'll see that in a second. And then the total wage expense, because remember, so far we've learned about journalizing wage and salary expense, salaries payable, things like that. So you're kind of figuring out where that comes from in reverse. So here's a payroll register. Pay close attention to this. Look in your book. Use the copy in your book when you go to do your homework. So they're almost always going to give you their W-4 allowances. So you don't usually have to find that. Maybe an occasional problem you will. Prior year-to-date earnings looks like here we're looking for anyone who's close to that 127,000 because that's a red flag in terms of their deductions. A couple of these employees are salaried. The other ones are hourly. So their hours, their hourly rate, the amount of their regular hours, and then we always calculate overtime separately because that's a bookkeeping thing. If you're paying a lot of overtime, then you might need to hire another employee, or you might want to look at, your efficiency. Maybe people are taking too many breaks, or, things are crowded. The law of diminishing marginal returns is kicking in there. So overtime is always kept separately, paid at time and a half, of course. So their hourly times their hours, hourly rate times their hours gives you their gross pay. We take the gross pay and add it to their prior year earnings, and that gives us our current year-to-date earnings, YTD, year-to-date. Okay? Then this is the employee's earning record that shows how much of the various taxes are taken out of the paycheck. Okay, so we have their earnings, their federal income tax, that's federal withholding, the tax table. State income tax, usually given to you as a percentage, or they just give it to you. FICA, which is Social Security, broken into OASDI, which is 6.2% of their gross. Medicare, 1.45, as long as everyone is under that 127,000, which they are. And then it'll give you, every employee has medical insurance. I think you already saw that a little bit in your last homework. So we take all of these, see how this says deductions right here? Deductions. There's no total deduction, so you have to add it up. This is a mathematical nightmare, so you be very careful when you're adding. Add all that up, all the deductions under this bracket right here, and subtract it from your gross pay. And that gives you your net pay, right? Your net pay is after your taxes are taken out. And then your book will tell you what the check number is. So the check number is actually their paycheck number that's tracked, right? And then their year-to-date earnings is going to be their gross pay added to their prior year earnings. So that's their year-to-date. Again, we're looking for someone who's close to that 127,000. So that is the employee earnings record. We always do the totals because the totals are what we are going to have to journalize when we learn how to do the journal. Okay, I'm not there yet. Okay, so that's pretty much what your homework's going to be on. It's very tedious. The tables are big. You make one small mistake and you miss points. So you have to be very careful calculating all these things. It's a little bit time consuming, but that's what we're studying right now. So the next thing I want to talk about are some special taxes. So there are some taxes that are only paid by the employer. So just think about it. Most of you are not employers. Most of you are employees. Someday, hopefully, you'll be an employer. And you now will realize that when you're making $12 an hour or $15 an hour, don't forget your employer is not only paying you your hourly wage, but they're also paying all of these benefits for you in your behalf. So we're going to talk about each one of those real quick in the next 8 minutes. So employer payroll taxes are taxes the employer has to pay. So Social Security, we already talked about that. Both the employer and the employee pay OASDI and Medicare, and it's a matching amount. So once you figure it out for the employee, it's the same deduction for the employer. Just remember that. It's the same amount. Once the employee makes $127,200, the employer no longer has to pay on behalf of his employee. That might seem strange to you, but we'll just leave it at that for now. Unemployment taxes, remember, unemployment is paid for into a pool by the employer. And when a worker becomes unemployed because he's laid off from his job or something like that, then he can draw unemployment. So basically, the employer is the one that has paid into that. And that was created a long time ago, kind of the tail end of the Depression, with Teddy Roosevelt in 1935, created a lot of the social programs that we still have today. So unemployment is broken into two branches: federal unemployment tax and state unemployment tax. So FUTA and SUTA. So federal and state unemployment tax is only paid by the employer. So it's never going to show up as a deduction out of the employee's paycheck. So they're given as different percentages. So it doesn't matter. They give you some more details here, but you'll see here. So the other critical thing is that federal unemployment tax has a wage-based limit. So once the employee, listen carefully, once the employee has earned $7,000 for their gross salary, then the employer no longer has to pay unemployment on their behalf. Okay, it's like OASDI, but a much lower amount. Okay, and the book will always give you the amount of federal unemployment tax. It'll be an amount. So FUTA and SUTA supposedly add up to a total of 6%. But your book, when they give you the problems, it never does. You just follow what they say. If they say that the FUTA rate is 5.4% and the SUTA rate is 0.6%, then you just do what they say. But just remember, the biggest thing is that there's a wage-based limit on federal and state unemployment tax. Once they've made $7,000, they no longer have to pay this tax, the combined tax. You don't have to pay it. You don't have to figure it out anymore. Okay? So remember that your book will always go with the 7,000. It varies by state, and you're a couple years out here because of the recency of your book, but the wage-based limit could be as high as $41,300, but it's not. For your calculations, your homework is always going to be that $7,000. That's a critical number. Okay, so let's talk about workers' comp. Workers' compensation insurance is different. It's not an employer tax. It is an insurance policy that your employers have to purchase, and so it's not taken out of any paycheck. It's not measured against any amount on a salary scale or anything. And basically what workman's comp is, which you probably already know, is it protects employees against losing all of their income if they get injured on the job. And I'm sure you've heard stories of workman's comp cases that are fraud and things like that. And that is a true thing that happens, but you have to realize that this idea was put in place so that if someone does get hurt on the job, they can still draw some money and be able to buy food, put food on their table, and take care of their kids and things like that. So the idea behind it is good. So in most states, we'll just use most states because that's the way Brooke is going to do it. The employer buys the workman's comp policy. So the policy is based on their gross payroll, and it's also based on the danger level of the job. So you can imagine if you are a farm labor contractor and you have crews of guys that are picking peaches or picking cherries and they're up on ladders, your workman's comp rate is going to be much higher than somebody who runs, a travel agency. That's a bad example, but that's what your book uses. Or some other office job where, the biggest thing that's going to happen is they're going to trip on the carpet or something. So workman's comp is just like automobile insurance. The better driver you are, the lower rates you get. So the safer your job is, the lower rates. And the fewer the accidents, the lower your rate is for workman's comp. So that's why a lot of businesses have safety meetings, because they want to keep their workman's comp insurance low. And that is one of the ways that you keep your workman's comp low, is you have safety meetings and you look for safety hazards and you put a big sign on the door, how many days we've gone without having an accident. That's so your employer can get a lower workman's comp rate. So here's how we do it. Hopefully I'll make it through this. They say a lot about it, but there's very few homework problems on it. So basically in this example, they have two categories of employees: schedulers, people who schedule other people to work, and managers. So which do you think has a higher, more dangerous job? And neither one of them sound very dangerous. But what they do is basically you buy workman's comp in $100 increments. So you have to guess the gross pay, at the beginning of the year, the gross pay you're going to pay your schedulers. So you estimate $50,000 for your schedulers and you estimate $190,000 for your managers. Divide that by 100 because you're buying it in $100 increments. So the rate for schedulers, you're going to buy 500 $100 increments at $1.80. So that's going to cost you $900. This rate is set by the insurance company. Your managers just sit in their chair and lean back a lot. So their workman's comp rate is only 22 cents per 100. So there's 1,900 hundreds and 190,000. So that's 22 cents. So add those two together, and that's the rate that the employer would pay at the beginning of the year. And then you have to go back. There I go. Then you have to go back at the end of the year, and you have to say, how much did you actually pay your employees? Well, I actually paid them $57,000. So the real amount that I owed was $1,044, and I only paid $900. So I owe a little extra. So that is how, same with this one. So this one, your employees, you estimated they were going to make $190,000. They made $220,000 plus change. So at the same rate, this is how much more we owe them. So that is the difference between the end of the year calculation and the beginning of the year calculation, is just more money you have to pay. So your total workman's comp is that. I don't even think there's a single problem that makes you do that. Okay, I think that's it for 7.2 and 7.3. The next thing we're going to learn about is how to put all this in the journal and the ledger, which I know you're going to love. So anyway, look for your homework. If you get stuck, be sure to email me. If you want to do a Zoom conference, let me know. We can Zoom at any time. Okay, well, I'll be signing off now. I hope you guys have a great week, and I hope Pearson is good to you this week. All right, take care. Bye-bye.